Hey everyone, thanks so much for joining us. I'm Pete Blackshaw. I'm the CEO of Centrifuge, and this is the fourth in our series of Fintech Frontier events. And it's on our way to our first Fintech pitch competition at the end of this month. Let me start by thanking again our founding partners, Western and Southern Insurance Group and Fifth Third Bank. Their leadership is a powerful example of the connections we can make to open up doors for local startups and encourage startups from outside the region to take a hard look at what's happening in greater Cincinnati. Now, we'll get to the panel in just a moment, but I want to provide a bit of perspective to help frame the conversation for those of you that weren't with us for our prior webinars. Our purpose and mission at Centrifuge on behalf of the entire ecosystem is to accelerate the growth of a tech-based economy in Cincinnati. And the primary way we're doing that is by establishing Cincinnati as the #1 startup hub in the Midwest and a top innovation center in the country. We have so much to work with. We've got a concentration of Fortune 500 companies eager to partner with startups. I repeat, eager to partner with startups such as Western and Southern, Fifth Third, P&G, Kroger, Scripps, Great American, the long list. One of the biggest lists in the Midwest. We have an equally great concentration of world-class universities leading research and growing entrepreneurial talent. We've got an ecosystem that's passionate and eager to support startups in every way they need. We have a growing pipeline of startups themselves that are putting Cincinnati on the map, on both the startup and the venture capital map. And we also have a growing list of local venture capital resources. And even in the last year, we've had a number of, you've probably seen in the news, a number of announcements about new funds coming to Cincinnati. Now, one of the most important things that we have done is to get crystal clear on where our region has a right to win. The few critical mass areas where we have what it takes to accelerate growth and distinguish us from the coast and other regions. We know making these strategic choices is a game changer. The regions with the greatest strengths and momentum are those that have staked their claims in a few critical areas where they have a concentration of talent, capital, and technology. Detroit and mobility, Pittsburgh and AI, Nashville and Memphis and health tech. The list goes on. Now, we are good at so many things, but that's also diffusing credit. It's complicating our selling proposition and with startups and even boomerang talent. So we are aligned to 4 areas where we have what it takes to win. Future branding and retail, supply chain and logistics, connected health, and drum roll please, the reason why we are hosting this series today, FinTech. Now I'll let Sarah and the panel take it from here, but I just want to underscore the power and vision that we're calling the Fintech Frontier. This is a partnership between industry-leading financial services companies based here in Cincinnati and fintech-focused entrepreneurs, all powered by Centrifuge in our role as Cincinnati's catalyst for startup innovation. Our vision is to create a launching pad for fintech entrepreneurs. We want to attract people who see bold possibilities and can make financial services accessible and engaging and transformative, for consumers in every walk of life. We want to open doors for founders who can create great ideas and who need enterprise customers who can help them succeed and scale. And so we can kind of like to think about our region, when it comes to fintech, as a place where Main Street greets Wall Street to help create the future of finance. So on that note, I'm going to turn it over to Sarah Phillips, a Centrifuge alum, I might add, but more significantly is leading innovation and partnerships for Great American, our very valued partner right down the road. Thank you again for joining us. Sarah, I give you the baton.
Thank you, Pete, and thanks for the introduction. And thank you to Centrifuge for having me and the panelists today. And thanks to all of you on the line for spending part of your lunch break with us today. Hopefully, we will have some interesting banter. We invite you to participate and join in through the Q&A button at the bottom of your screen. And I invite you all to, follow up with any questions with myself or any of the panelists afterwards as well. To get us started, why don't we go around the panel for introductions with the group? And Kyle, why don't we start with you to give a little bit on your background and your role, and we'll do that through the panel, and then we'll jump into questions.
Great, happy to provide a little bit of context. So I'm a senior investor within American Family Ventures. We focus primarily on investing in seed through Series B startups, so fairly early stage. And thematically, we focus on the future of insurance. I personally have a heavy background in data analytics, software as a service, and have spent a couple of decades in and around the insurance industry. So I tend to tilt personally toward those kinds of companies, as well as those in real estate and prop tech. And I'm based in the Boston area.
All right, Elizabeth.
Yeah, hi, and thanks for having me on the panel today. I'm Elizabeth Caven. I'm the Managing Director of the On-Ramp Insurance Accelerator, which is a partnership between Generator, Allianz Life, and Securian Financial, and I am in the Twin Cities. I invest across InsurTech, FinTech, and enterprise technology. Excited for our discussion today.
Thank you, Elizabeth. And Justin.
Good morning. Super excited to be on the panel today and chat with you guys, as well as with any questions with the group. So my name is Justin. I lead innovation for Fifth Third Bank. So I'm joining as one of those corporate partners who's super excited about having more startup ecosystem, fintech specifically, in the Cincinnati area. I am not from the world of finance. I come from the world of technology, different consulting, you name it. Banking was not my background, but I've fallen in love with banking after relocating myself and my family to Cincinnati, joining Fifth Third. So not from the region, but really excited to see all the potential it has and for what is to come, just because of all the things that Cincinnati represents, the Midwest represents, and the opportunity it presents for startups to really drive change and innovation. So excited to chat today, though.
Awesome. Thank you, Justin. And as Pete mentioned, I'm Sarah Phillips. I lead strategic partnerships and investments at Great American Insurance for the P&C business. I have one of the greatest jobs in the world because I get to spend my time working with fintechs, insurtechs, entrepreneurs, investors, co-investors, and the broader community that supports this vital part of our ecosystem. My background is in investment banking, private equity, and venture capital investing, and I am located here in Cincinnati, Ohio. And I will say, as a non-native and someone who's lived on both coasts, I very much am an advocate for the region and all the great activity here. I think that there is a lot of really special activity and really special talent, and I hope that you come away with that impression after our discussion today. So I'll open with a big picture question for the panel. As we think about the coast as a hotbed of activity in the startup scene, for both founders and for investors, what do you think is behind the trend of startups launching ventures outside the coast? And what strikes you as the level of activity here in the Midwest in terms of where we are in our life cycle? Have we matured? Are we very much in the beginning? Let's start with Elizabeth.
Sure. That's a big question and a very important one. I mean, I think we're continuing to see the ecosystem within the Midwest grow. I kind of like to say there's no monopoly on the great ideas and execution skills. The coast don't own that. So we see a lot of founders that are wanting to live in the Midwest, creating their businesses here. And I love to see that. In terms of kind of what's happening and kind of the ecosystem and where we are in the life cycle of building businesses in the Midwest, I mean, I think it's interesting that there are so many Fortune 500 companies that are located within the Midwest. It's kind of an outsized number compared to other areas. And those corporations are starting to really invest in innovations, not just internally, but looking externally. And I love what Pete was just saying, where these companies are not only just wanting to partner with startups, but eager to do so. And so there's a lot of exciting things happening there. I'm curious from Justin's perspective, because you're in one of those corporations. So I'd love to hear your perspective on that.
Yeah, I mean, so I will, full transparency, I've lived on the coast before. You know, there's that glistening gleam of you have to go there for innovation. And I think that's more of just a product of history proving it. When you really look at where are schools, where is the concentration of population, where is the concentration of Fortune 500 companies, the Midwest has a tremendous amount to offer. Are we fully matured? Absolutely not. We have so much runway, so much potential. And I think conversations like this, getting more honest and open about, hey, you can have a thriving startup that's anywhere. Why not have it be in a place that's closer to some of the top universities in the world, closer to, 50% of the American population lives within like a one-day drive of Cincinnati. There's so much here that the notion of you have to go elsewhere is a very powerful message. And I think we see that with a lot of students. Just up the road from Fifth Third, you have UC's 1819. There's a lot of activity going on with innovation of businesses investing in it. And a lot of it is just helping keep the traction. There's so many good students, so much talent that comes out of universities. We really need to help people just understand you don't have to leave. There's plenty of opportunity here. Plug into the ecosystem, get the ball rolling.
And I can
Thanks,
just add to that,
Justin.
just from one perspective I would share is we have one of our portfolio companies that's based in Ohio, that not in Cincinnati, unfortunately, but in Columbus. And it's very interesting that that was not just a convenient choice. They're a pretty objective team, and really they built a extensive model to understand across dozens of dimensions, grade every city in the United States of where could they be headquartered. And the focus was on identifying places where employees would have the highest quality of life and kind of financial opportunity, life-work balance, et cetera. And the result of that was, in this case, Columbus, the city in Ohio, was the choice. It beat out cities on the coast, et cetera, when they were evaluating that. They were prepared to move anywhere, and that was where they chose. So I think that there's a really strong argument from the standpoint of creating a locus for employees for long-term growth that can be a great opportunity by being based in the center of the country.
So, Kyle, American Family Ventures has been a leading player in the insurance industry since you launched in 2013. You've deployed over 170 million across 65 startups over the past 8 years, including Bold Penguin, who we were talking about, as well as Branch up in Columbus, Clear Cover in Chicago, and many others. As you scout, I imagine, nationally for investment opportunities, seeking startups to deploy capital and offer your support on an ongoing basis, do you find it easy to find startups in the Midwest? Is it harder to find good opportunities here relative to the coast? Talk a little bit about how you look for opportunities, what led you to invest in companies in the Midwest, and what the result has been in terms of shifting your scouting activities ever since having discovered the region.
Yeah, absolutely. So, I wouldn't say it's necessarily easy to find companies that are outside of the coast, just in terms of the kinds of quantities that we interact with daily when companies are reaching out to us to pitch. And there's still a higher percentage of those points of outreach come from the coast. But in terms of the reason why companies that are based in Midwest we find particularly attractive, a reason for that, we focus on companies that are going to be interacting with industries like insurance and banking. And many of the talent pools for insurance and in banking are not concentrated on the coast. They're going to be very frequently in different kind of cities between Denver and Ohio. And so from that perspective, when we're dealing with companies that are trying to navigate through heavily regulated environments, we really like subject matter experts to be part of the founding teams or the senior side of these companies. And so just getting that subject matter expert talent is sometimes quite benefited by looking at hubs where insurance companies tend to be or where banks tend to be. So I think that's actually a key reason why we would be attracted to those kinds of areas, because of the senior leadership talent, as well as the ability to hire over time. I think it does present a little bit of a risk over time as well, though, if companies need to hire extremely large amounts of software engineering talent. You can find that maybe that is a little bit more complex. So companies might have to have a multi-city strategy over time, but that's a problem that comes significantly downstream and is very manageable. So I'd say that's the key reason for the themes that we invest in, why we're really attracted to the middle of the country.
And Kyle, as you think about the difference between fintech and insurtech, and you think about the difference between financial services mostly being regulated at the national level, but insurance being regulated at the state level, is there a geographic component to where you're looking for insurtechs versus fintechs, or does location not matter?
Yeah, I don't think that the state-based regulation for insurance plays a huge role in our thinking. I think it is more about just making sure people are well equipped to navigate those environments when they do face them. So we haven't focused too strongly around being headquartered in a state that has a certain regulation environment for insurance, but we've really focused more on making sure, are you in a place where there is a substantial talent that you're going to need over time, and do you as founders or the executive team really understand what it means to build a mortgage business from the ground up, or to build a personal insurance business from the ground up, which is highly regulated, or can you navigate situations where you're kind of straddling different functions but not explicitly being a broker. Those are the kind of things that we want to make sure people are equipped to navigate, and often that comes with deep industry specific expertise.
Yeah, fair enough. And I see a question here in the Q&A, just inquiring about reg tech as well. I know that you guys invest across fintech and insurtech. Do you have a focus from a reg tech perspective?
We are very open to investing in that space. We haven't made any investments to date, but we're very interested in hearing those concepts or those ideas. So if any of our attendees today or others in their networks are working in that space, we'd love to hear the concepts there and explore them. I'd say the areas that I didn't really mention, but I'll just mention it here. It's not explicitly reg tech, but we definitely are interested also in the reinsurance market, insurance-linked securities, different forms of alternatives to insurance, which can be parametric types of risk transfer. And each of these will have different ways in which they intersect with the regulatory environment, some more strongly and some less so. So it's not exactly reg tech per se, but I just wonder if we could broaden that perspective of the kind of things that we focus on, because we really want to touch anything that's tied to property, casualty, life, or annuity. We focus on any company that's relevant to that category.
Fantastic. Thanks, Kyle. So Elizabeth, with on-ramp investing in just 5 companies per accelerator cohort, that means that you have the capacity to dedicate more time and resources to each startup in your home base. And as you get down into the deeper levels of helping them from a talent perspective, in addition to the many other facets that I'm sure you're involved with, if you think about talent as such a critical part of a region's appeal, is attracting the right talent to Minneapolis either to build the team out within your accelerator, or looking locally for talent to augment the teams that come to build their companies with you? How has that been? Has that been a challenge? Has it not been an issue? How do you characterize the available talent in the Midwest, and how do you characterize the success in attracting talent from outside the region to support these companies?
Yeah, it's a great question. I mean, I think attracting top talent is an issue across all startups. But when you're trying to do it outside of like a top 10 metro market, of course, there's added challenges. And Kyle highlighted some of this already with, engineering talent specifically. The good news is I think this work from home environment is perhaps changing the conversation a bit and allowing people to choose where they want to live and not just feeling tethered to where their employer happens to have an office. So that opens up, a real opportunity, I think, for us in the Midwest. So we haven't seen too much of an immediate challenge, but as companies scale, of course, there's tough competition for top talent out there, but we believe that you can find that within the Midwest. And to Justin's point, with all the universities that are around as well, that's just a great place to be located near all of those, which we can find in Minnesota, you can find in Ohio, and throughout the Midwest.
Yeah.
And kind of add, I was going to add to that, the notion of fintech struggling to find top talent. This exists for businesses that are driving change and transformation in general. When you think about technology expectations, the needs, there's only so many software engineers out there. And so regardless of whether you're a small startup, you're a mid-sized company, or you're a Fortune 500 company, the talent, there's always going to be competition for it. And ensuring that you can get a healthy pipeline, that you get a vibrant community, that you get people who are engineering thinkers to solve problems, that is what the Midwest has, but it's also what we as a larger company, like, we want to have more of that. The more startups, the more vibrancy, the more you're going to just attract that talent, the more that big companies can start adding to that talent pool and pulling from it. All ships rising will help all of us in this scenario. So it by no means is, oh my gosh, it's so tough for startups to find top talent. It's a need regardless of the business. And I truly believe the Midwest has a tremendous amount of it available and has the reason and the mandate to push to get more of it brought back here, or at least keep it here, to keep from that whole, hey, you got to leave if you want to make it in the software world. Really? We work on software. You can be most anywhere. Why not be in a place that has a lot of the same offerings as the coastal regions, but it's a little bit more affordable to live through it?
Yeah. So Justin, as you think about that, right, the difficulty in attracting top talent, understanding this kind of shifting trend away from traditional banking services towards a more technology-minded business, right? How do you have been tasked with a massive mandate at Fifth Third to shift the culture and start to create a more tech-savvy culture within, to attract talent to Fifth Third, and also attract fintechs and partners to work with your organization. That's a lot. How has your experience been working at 167, the Innovation Center within Fifth Third, and shifting that culture and that mindset within your organization? Yeah,
so kind of first and foremost, it's definitely not one person ever responsible for shifting the entire culture. Like, one of the big things I believe, innovation comes from how do you get innovation from as many as people as possible, really just igniting that spirit of innovation to help drive it forward. What I will say though, the leaders at Fifth Third have been very intentional of, we're a relationship bank. And when you think about being in relationship, you're thinking about people, the human element. And I think that is what gives people a mission to go after. So when you think of attracting top talent, you can't just be like, hey, we're gonna build widgets and you're gonna come here and you're gonna love it. Like, that doesn't excite people. What excites people is, hey, here's a problem that we're solving for real humans, for real customers, for real people. And it's those type of inspirational things that many corporations, I think, for too long ignored. Like, they left out that human side of it. But with Fifth Third, we're really looking at how do we help our customers, whether it's through COVID-19 or whether it's just they have goals, they have aspirations, they have things they want to achieve. We can give them those tools to go for. And so yes, there's a little bit of, hey, we just need to find that top talent, bring them in, but you have to have a really clear mission and vision of what people are going towards. And I think that's very true within the fintech space. Like fintech, well, financial services touch more aspects of everyone's life than almost anything else. You think of getting stuff delivered to your home for food and just the shipping and the logistics of that. Well, finance is what's connecting that and making it happen. You think of healthcare. Healthcare, regardless of how good healthcare is, at the end of the day, there's going to be some aspect of financial involved in it. And so we stand to create the tools, create the opportunities, create those services that change customers' lives and have an impact through a relationship. That really helps them live the life that they aspire towards. So it's not just saying, hey, we're going to build some cool stuff. It's really getting people rallied around that vision. And I think that's one thing Fifth Third has done, but you see it across many of the other companies in this region. We're a region that builds stuff for people, not just for, we're producing widgets left and right, here we go. And I think that's exciting about what we're up to, at least.
That's, very exciting, right? And that's, I think, a big part of what we're all trying to support and do is think about what could be from a business model perspective, from a customer engagement perspective, from an enterprise operational perspective, and certainly from a data and analytics perspective when we think about better serving and conducting business and knowing our customers at a different level. I have to ask Justin, because you talked about how finance is baked into many of the things that we do each day. So we engage with, in our routine as consumers, we engage with many different products and services, with finance being an underlying component of that, whether it's processing payments or any other level of engagement. As you think about fintech as its own platform, we have the web, the internet, right? And companies first came online and had an online version of their existing storefront, right? And then it evolved to a proper distribution channel and a channel to conduct business. As you think about finance embedding inside other businesses, what do you think about platform play, and what do you think about, the kind of relationship-driven role where people want to touch and feel their financial services versus the role of finance as a platform to be in the background and power those experiences to really be just a seamless component of it?
Yeah, so from that kind of, one of the big aspects of platform plays, I think too many times it is relegated to, oh, it's just behind the scenes. It's it's invisible, it's transparent, it's just there. I really don't believe that that's the opportunity that presents itself. I think where you're going to see this kind of evolution occur is it is in that relationship aspect. One of the tools that I lead for Fifth Third is our digital messaging capability. And when you think of what happened earlier this spring as COVID was starting to set in, there was, concerns of people just figuring out what comes next. They were reaching out to the bank to get their questions answered, to keep their businesses alive, to get those questions, to get some resolution. And we quickly pivoted and got digital messaging out there really quickly, quite honestly. But it was for that expressed intent of people are calling, and people are doing so not just because, oh, you're my banking platform, you do stuff in the background, payroll, you name it. It's because people had questions and they wanted somebody to help guide them through whatever their question was. I think that's going to be the interesting emergence as we think of where fintech, the platform play, the financial industry starts to come together. Is it's not going to all just be payments, but what are those technologies that allow for human connection, even when it's virtual, when it's digital? And how do we help ensure that things don't just become so mandralic in nature where it just happens behind the scenes? Because ultimately people will have, like, I don't know about you, back in the day when I went for student loans, I had no clue what I was signing up for. And just the notion of, man, I could have used somebody to help me walk through, to think about just what finances I should use, shouldn't use, would have been helpful. And the more that we can figure out, how do you bridge that? People aren't walking into branches as much, but how do you enable more people in more places to always be, one tap away from connecting with a human and getting those questions answered? That's going to be exciting. Having a global pandemic has only helped accelerate changes that were happening. I don't think anything has just shifted, but we're starting to see more and more of, relationships matter. When you have a problem, you want somebody to connect with. That might just be over a digital messaging tool. It might be because you call, it might be because you walk into a branch. But that's where fintech has a really big opportunity there, is how do we better enable those experiences wherever people may be in whatever stage of life?
Yeah, that we see, I concur, and we see a lot in the insurance space as well, with the critical role that agents play in our value chain. So Kyle and Elizabeth, as you guys think about investing in companies and kind of understanding where companies choose to locate or build their business relative to source of funds, right? Kyle, you're in Boston. You've made investments in the Midwest. Elizabeth, obviously you work with companies that are based in the Midwest, but you're also helping them raise outside capital. Is there a relationship between where a company is located and from where they're able to raise capital in the venture space?
I'm happy to start with that. Maybe just as a preface, also mention I'm in Boston, but I'm from Kansas City originally and have also lived in Minneapolis. So I've got some Midwestern roots. In fact, we even have a limited partner based in Cincinnati, which I forgot to mention. So we've got a lot of ties to this conversation. In terms of the fundraising and kind of if one is located in the Midwest, how does it affect fundraising? I would say if we looked back 2, 3, 4 years ago, it probably would have actually been a little bit of a burden. It was definitely a little harder to raise capital from venture investors particularly the early stage, if you weren't close physically to where those investors are located. I think that has changed considerably in the last 2 years. We've got a number of the kind of traditional coastal venture funds that maybe are kind of top of mind brand names. They specifically task people with engaging startups in different parts of the Midwest. So you will for those funds that were designed around a given community, in the Midwest previously, they're finding more and more venture capitalists entering in to the area and competing for investment opportunities, in these Midwest cities. So I think it's less of a barrier for a fundraising perspective than it once was. And I want to just maybe tie on to the prior point as well, which was, I think, thinking a little bit about the innovation side of being in the Midwest. One of the things I think is one of the most exciting parts is that some of the core concepts around product distribution that just work, are, even if they are not the most technologically sophisticated, I think you will find perhaps a greater propensity for companies in the Midwest to think about new strategies to enable agent-based distribution. And sometimes that's not as exciting of a topic, if you're a venture capital team that's looking for everything to be technology powered, but there are certain things that just are sold more effectively through people. And if we can just enable those to do that more effectively, that is often a win. Our investment in Bolt Penguin had a lot of those thoughts behind it. And in the lending space, we invested in a Denver-based company named Need Capital. And again, they have just done a fantastic job leveraging loan officers as one of their key strategies for selling their loan product, which one might say is less technologically sophisticated, but every other aspect of their business is so strongly tech-enabled that they can distribute through the highly dependable and scalable strategy of loan officers and do extremely well at it. So I think that that's one thing I would raise, is that it's having different strategies of distribution that include in the right ways agents is something we sometimes see more openness for companies that are headquartered in the center of the country than on the coast.
Yeah, and just kind of piggybacking on some of that too, if I can, with the Midwest, we had an accelerator cohort just finish their cohort with us in August. And it was a really unique time when VCs to meet with these companies didn't need to get on airplanes. So we had an increased willingness of coastal VCs even to talk with companies from anywhere because they could do it virtually, which really fostered some interesting conversations. We had 125 different investors engaged in our last cohort, which was fantastic. And a lot of those were from the coast. We also seen in one of our recent portfolio companies located in Silicon Valley wanting to raise purely from Midwest VCs because they really found the conversation style is different. The relationship building was slightly different. It wasn't just the feeling was so much better from their perspective. And I loved hearing that there was a different scene even from the founders in the Midwest VCs versus others. I think one thing to note though is that startups will go where the capital and the liquidity is for them. So that's why we still have part of this conversation where the coasts are very enticing for startups because they know that all the big funding announcements seem to come from different coastal VCs. So we have an opportunity to kind of change that narrative in the way that we talk about the investments that we're making here. But the liquidity piece is an interesting one too, because you still hear about the Microsofts and Googles of the world that are acquiring so many companies, and it's attracting some startups outside of the Midwest. So from our perspective, one of the things we talk about at Generator a lot, Troy Vossler, the co-founder of Generator, has a study that he constantly is keeping in front of us as a team that was done a couple of years ago, and it showed where capital flows in and out of the Midwest from. And there was about half at the time, about 47% of all capital from pension funds that was allocated to venture capital flowed from the upper Midwest, but only 12% came back to startups within the Midwest region. And so seeing this big disconnect and unbalanced nature of capital flowing out versus capital flowing into these startups just shows that more work is to be done. I think they're going to be looking at that study again, and I hope that we've moved the needle on it a lot. But for the investors and for funds, that are kind of on this call and listening to this, one of the important things to do is just continually look at the allocation of your capital relative to the investments you've made in the Midwest. Is it increasing or decreasing over time? And we're continually trying to increase our allocation in the Midwest for sure.
So as you think about deploying capital here and you think about companies on the coast seeking investors and kind of being drawn a little bit more to maybe a cultural difference or a little bit of a stylistic change from venture capital firms on the coast, do you think that there's also a valuation component to that? Have you seen multiples be different for companies or term sheets that go out or even structures be a little bit different between the Midwest, either from a venture company perspective or from a venture investor perspective?
That's a great question. I think Kyle, yeah, I'd love to hear your insights.
Yeah, happy to provide some thoughts. I mean, I think in general, it varies, substantially, but I think it is I think fair to say that you will find companies that are based in San Francisco, based in New York, or perhaps based in Boston may command a higher valuation relative to a similar stage of product or revenue development. You could kind of debate on the reasons why that might be present, but there's certainly more competition amongst investors. So that could be one element that you might consider there, is that if there are lots of investors seeking to identify companies locally, it can kind of drive up enthusiasm and drive up potential price of an investment round. I think there's other reasons why that might be true. You'd find, there are definitely questions about hyper growth capability, including hyper growth of talent. And so if a company is growing with an exceptionally fast rate, depending on the types of talent they'll need, but particularly if there's a perception of engineering talent, some investors might see that there's a lower barrier for that hyper growth of engineering talent if a company is in the positive position to do that, if they're based in a local hub where there's just such a high number of engineers present. So there can be those kind of arguments. I think also just venture investors, particularly at the early stage, sometimes have a bias to be able to have maximum face time or at least maximum ability to interact with a company. And I think that they personally will probably put some weight on that if it's down the street as opposed to a long flight away. So those are some reasons why I think pricing could be influenced, but I don't feel like it's as strong of a issue today as it was previously. But I think that it would be probably unfair to say it's not still present.
Thanks, Kyle. So as you think about, the significant differences, advantages, disadvantages to growing a startup in this region, and you also think about the impact of the pandemic that Justin referenced earlier in terms of location being less important when you're looking to attract talent, if your company is in a hyper growth phase and you need to attract a specific kind of talent that's not found locally, what do you think will persist post-pandemic in terms of an appetite to have a more dispersed workforce? How do you think that impacts with a startup? Certainly working very closely with startups, there's a lot to be said about building a culture and co-working and being in the same space to develop those really close relationships at such an early stage with a company. That's so critical, right? But what do you think, what are the advantages and disadvantages, and how do you think the openness now to hiring talent outside of your region will persist once we kind of come through this global pandemic phase?
Yeah,
Elizabeth or Kyle? Yeah.
Yeah, I could throw a thought out there. I mean, I think that I've increasingly, interacted with companies who are building their talent from the basis of a remote first philosophy. So in that respect, they're trying to make sure the way they operate as organizations is culturally embracing a remote first operating model. That doesn't mean they necessarily only want people that are remote, but that if you are remote, you shouldn't have an experience that's kind of degraded or second class compared to those who are not. And so I think I think that'll actually be increasingly true going forward, that people will be designing their cultural norms of communication, meeting and the way knowledge flows through an organization with a remote first philosophy. I think another observation we've seen, some of our portfolio companies that are coastal, in the past 3-4 months have seen, low double-digit percentages of employees raising their hand and saying, "Okay, I don't think there's a strong argument for me to stay in this extremely expensive market." And so I think you also see people that are responding to some outflow of employees from these major markets. The kind of the counterpoint to my remote first, kind of statement at the beginning, though, was we have seen some instances where, some employees just so deeply value, and many of us may have experienced that ourselves, so deeply value the human relationship that comes with being present in an office together, that if a company is remote only, it can also create a retention challenge for some people that for whom that doesn't work well. So I think finding the right mix is important, but I think the barrier is reducing, not increasing, for that to be a strong option.
Yeah. And I'll put this question from the Q&A list out to the group. It might be best suited for Justin. Tim had asked, relationship startups to big corporations. You know, as you work, I'll take a little bit of liberty with the question here, and I hope it's down the right path of inquiry. But as you think about working closely with startups and you think about getting to know really great talent that startups have worked hard to bring together, do big companies also poach talent from startups, or can you think about a little bit more as, you know, if a startup fails, working closely and being located where large corporations exist, does that actually offer a soft landing pad for these teams? How do you think about that?
So kind of on the surface, like that first kind of layer to the question, do they poach talent? Absolutely. I hope we are. But I will say it also goes the inverse. You know, one of the things that I find working for, in my own career, I've worked for very small companies as well as my own, on up to, you know, Fortune 10 companies in terms of size. And there's pros and cons of being with each, and you learn different skill sets and needs. You know, when you think about what are some of the biggest challenges that fintechs face, it's the cost of customer acquisition, it's scaling, it's distribution channels, it's all of that. Well, guess what? Corporations have a lot of people that are really good at doing. It's usually customer acquisition, it's having scale, it's productionizing things, it's making it happen in mass. And so, yeah, can you see situations where, you know, as a corporate, we want to hire more and more talent, and if we can get that talent pool brought here via startups, absolutely want to poach them. But likewise, there's people who come from financial industries who are like, you know what, I want to pause on this and I want to shift over and focus on this idea that I have, or I want to tackle this challenge. Or there's learning opportunities that go both ways. So I think it's not as much a concern of, do people poach from one way or the other? I think it's more of, how do we make sure that there's a fostered collaboration to where you're having these conversations and engagements. And yeah, if a startup fails, making sure that they're already plugged in with an enterprise, with corporations who maybe have a new idea for them to go challenge and go after, or have a softer landing, so to speak. There's just tremendous amount of cross sharing that I think can take place. And that for me is what I see as being a huge value within my team of connecting with the startup ecosystem. It's not for us just to hire from it. It really is, we want to learn from it, but we also want to help them to understand, like, here's how corporations are tackling problems. Here's the challenges that we need solved. It really can be a two-way street, I believe.
Yeah, I think that we all win when there's a virtuous cycle, right? And there can be a sharing of talent and ideas, either through partnerships, through you know, kind of changing employee badges or the like. It really fosters, I think, a lot of learning on both sides of the fence, especially with how important commercial partnerships, to your point, are to these startups. And so Tim Metzner, who actually had a business years ago, Differential, that promoted that virtuous cycle from tech talent coming out of large corporations, working on startups, spinning back out, has submitted a question over Q&A about the pending Root IPO. Kyle, you may be best suited to answer this question, but he's asking, you know, how important do you think that pending IPO is for the Midwest and for our region? And how much does the success help or potentially hurt, right, if it's on a successful IPO? What would the impact then be on the Midwest ecosystem?
Yeah, that's definitely tried and add some perspective to it. Yeah, I haven't really thought deeply about, what Root's next steps would mean specifically for, the Midwest or the geography that they're in. I mean, I think, I'm excited for what they're doing. Hope that they have a very successful journey ahead. I think that if they have a substantial fundraising event, in an IPO, I think what that would, or if they have a substantial fundraising event privately, what that would,
Mhm.
I think, mean if they choose to then, deploy that capital toward hiring substantial people, locally, in their headquartered location or otherwise in the Midwest. I think that could perhaps increase competition for talent. So it could, that could be the pro and the con, perhaps, is it could, that could make it a little bit more challenging to identify folks if you're trying to build a new company, but could be great for the economy and for, what folks are trying to achieve as they're building their careers. So I think that's part of where my mind goes, is just what it means for employment and talent, and the salaries and that demand would call for. In terms of other thoughts around the Midwest, I think a really successful journey for companies like Root, I think it can help validate that that some of the really core insurance knowledge that is behind many of these insurtech companies. There's two in our portfolio, Branch and ClearCover, that have a similar journey, and we really think that subject matter expertise is hypercritical. And so I think positive steps like what Root's endeavoring to do can be a strong statement in support of that. And again, a lot of that subject matter expertise is not only in New York or San Francisco. It's in other areas that have the history of these financial institutions being present. And so I think that could be again, a positive validation that more people might be inspired to do similar things.
Yeah, I think they provide a role model, which is something that we need to continue having more and more. We need examples of companies that are Midwest based, that raise capital. They choose, to Kyle's point earlier at the start of this, they choose that location because it makes sense for their business. And then they can grow a really successful business around it and see an exit. I think that's incredibly inspiring. And it's the whole, you can't be what you can't see type of attitude. It gives us more role models that startup founders could say, hey, I think I can build my company right here in the Midwest and make it go because of those. But the most important thing, as Kyle was mentioning too, is that capital then is reinvested. And more importantly, the institutional knowledge that comes along with that growth of that company and through the exit comes straight back into the local environment as well.
Yeah. And there's also, it's a unique experience to be at a company that's grown to the level of going through the IPO process and then managing a company post-IPO. That experience in and of itself is valuable to other startups in the region. As things come full course, you've got someone who's been through that, that can be a real asset to other startups as well. So I think only good things, can come, and even competition for talent, I think, is a positive outcome.
Can I just add one more thought? Sorry to speak over you there. But, the thing that also, when we think about, Midwest-based companies having large exits, typically what that means is that there's a lot of individuals with capital who can then power entrepreneurs or go start things themselves. And so it typically has a strong multiplicative effect. And so I think that's another possible outcome, is that one success begets 10 new companies, which hopefully begets success, and it repeats. And I think that's possible of what can happen with some of these really large exit opportunities.
Yeah. Yep. Feed it back into the community. Become an angel investor. So I see another question in the Q&A pane. I think maybe Elizabeth and Justin, but certainly Kyle, chime in. There's a question about fintech is a very broad space, right? Fintech seems niche from an investment perspective, but if you go into fintech, there are very, very complex areas like payments as one, where really diving deep into payments, really diving deep into lending are very, very niche subsegments. And so, Rafi, if I believe that this is your question, as you think about different areas of the Midwest, or an advantage within the Midwest of choosing a specific sector within fintech to access the expertise, resources, a network of experts in that space, are there areas in the Midwest that have an advantage there versus the coast? Or there are subsectors where it's more advantageous to access deep expertise here in the Midwest with the banking culture and the larger kind of financial services expertise relative to starting a very niche subsector on one of the coasts where you might not access that talent?
Yeah, I think that's a great question. And it goes back to what we've talked about with the corporations as well. So I'm thinking of Minneapolis specifically because it's where I happen to be located. But, you know, I'm working with specifically on the life and health side. When we look at the corporations that are in the Twin Cities, they tend to be, you know, the United Health Groups of the world, right? And Best Buy is very interested in health. We have the life insurance with Allianz and Securian. And so there are kind of niche applications that could be brought about in this environment because of who's around. And that goes back to the talent discussion, because there's a lot of people who have worked in these companies with deep knowledge and expertise that might be looking to jump into a startup. It also is because there's good potential pilots and corporate partner opportunities. So Justin, I'm curious on what you see as well in your location and working more on the financial services side.
Yeah, so it's always kind of a tough call of, do you have deep expertise in one domain or that broad notion? You know, there are some areas where when you think of like security and how do you keep, you know, authentication of customers and keep, you know, all the data safe, that's one of those that cuts across a lot of industries. And so, you know, when you think of startups that are coming about that might be focused on identity plays or fintech security plays, I would challenge them to think maybe a little broader, because one of the things I love about some of the collaborative innovation work going on across businesses in this region is, what are the things that on the surface we might look at an insurance company and go, oh, well, they're different than us. We're a bank, they're insurance, we have no commonalities. But when it comes to things like cybersecurity, turns out we have a whole lot of commonalities. And you see this across sectors. You know, Kroger being in town here, on the surface, it's like, well, they sell food, we sell financial services, nothing overlapping. Again, security and identity and looking at consumer patterns and what people do. There's advantages to push startups to think about, you know, take their very focused idea, but then look at maybe it is applicable to other domains. The flip side of that, though, is, you know, a few years ago, we, as Fifth Third, acquired a company called Dobot out of Denver. And it was specifically, Dobot is a robot for your dough. And it is really well focused on how do you help people save towards their goals? How do you help people save automatically where they don't have to think about it? And so that's one of those where it's a very niche need, and it's specific to the financial services industry. And that was an excellent opportunity for us to go after because it really solved the customer need. So I always challenge startups, if you have something that is really baked well, challenge yourself to look at what other industries are you not thinking about that really have overlap with it. And if you're looking towards that idea of what you need to hone in on, figure out a pain point for people and then build towards that. Because if you came to us with a really awesome opportunity of something that solved a very specific pain point, that could be super interesting for us as an innovation team to connect with you on, to collaborate on, to look at how might that come to life in what services and banking opportunities provide. So yeah, I always struggle with that whole aspect of, do you go broad, do you go deep? There's a balance with it. It's going to be kind of fine tuning and figuring out people and then figure out where all it goes to. Very rarely is it that people have this like light bulb, oh my God, this has never been done. It's usually building on other things already happening. And those other things tend to be from cross industry, but sometimes it's very specific in an industry. So it's more case by case, I would say.
Thank you. Thanks, Justin. I mean, I feel like there are so many more things that we could talk about. This has been such an interesting discussion. I got the nudge on timing, so I'm going to turn things back over to Pete to kick off the next segment. But Kyle, Elizabeth, Justin, thank you all so much for letting me pepper you with questions and for sharing your perspectives and thoughts on this topic for the group.
Thanks.
Thank you. Pete?
All right, well, let's give it up for our panel. That was outstanding. And as someone who grew up in Southern California, didn't know much about the Midwest, this dialogue really kind of reinforced what I think was the best decision I made in my life, which is to kind of pursue my startup ambition, my entrepreneurial opportunity here in the great Midwest, or what I sometimes like to refer to as the great supply way. So thank you for that perspective. Thank you, Sarah, for moderating. I posted a few fun tweets out there, and but I really appreciate not only your participation, but your commitment to this really important ambition. And it's bigger than Cincinnati, and it's really about the great Midwest. So thank you. We're going to move on to our startup showcase. True to our word as an innovation catalyst, we are going to give you a chance to hear from two very, very exciting startups, and then I will give some wrap-up comments. So without further ado, it is my honor to appreciate Mohsen Massoud, who is the founder of Tokenism, and he's going to take a few minutes to kind of talk about his model, and then we're going to hear from Kevin Mackey of Coterie. So, Mohsen, you have the floor.
Thank you so much, Pete, for the opportunity. And Centrifuge is doing great, amazing things for startups in the region, for sure. No question about that. Without taking up too much time, I'm going to get into Tokenism. Again, as Pete said, my name is Mohsen. I'm the founder for Tokenism. Tokenism is a platform for fractionalized sales of real estate investments. We're utilizing blockchain and AI for for creating this platform and seamless transactions. Just a quick short video on what Tokenism does and how it works.
Tokenism is an online real estate investment platform for new and experienced investors. By using artificial intelligence and blockchain technology, we've created a secure and intuitive marketplace that enables people to invest in institutional-grade commercial real estate opportunities. Until now, direct private market investing has been largely inaccessible due to the high investment thresholds, forcing investors to settle for suboptimal investment vehicles offering low returns or limited flexibility. The solution is investing in fractionalized real estate. By using blockchain, the underlying technology behind cryptocurrencies, we are able to fractionalize real estate properties and offer those ownership fractions for sale as digital securities. Unlike traditional cryptocurrencies, these tokens are backed by real tangible assets, and the immutability of blockchain guarantees an investor's ownership. Tokenism offers access to this formerly unavailable investment class. Diversify your portfolio with affordable tokenized direct investments in properties of your choosing, starting as low as $1,000. Start your real estate investment journey today with Tokenism.
So just, that was a quick brief on what the current real estate sector challenges are and what our solution is. So from high barrier to entry, requiring large amounts of capital to getting into the market, difficulty selling the properties, potential fraud, low returns, day-to-day management issues. Tokenism is looking to resolve each of these real estate sector challenges by providing minimum investments of $1,000, instant liquidity, the opportunity for near instant liquidity through our secondary market, high-grade security using blockchain, immutable record of ownership, direct investments in single assets as opposed to a portfolio. Now, every business went through massive change post-COVID, as did we, and we completely looked at everything that needed to change. We adjusted our roadmap, reviewed our costs, reprioritized our platform, eliminating any third-party needs. Here's a roadmap of where we are. So we've just launched our beta platform as of Monday. So go to tknism.io to sign up and get a feel of what it's like to invest in fractionalized real estate assets. We currently have one asset that's on there, with 2 more coming this week and another 11 more in the next 6 months. We expect to do our formal launch at the end of the year, secure a broker-dealer license by Q2 2021, and then our ATS license or full exchange license by the end of next year. Just to give you an idea of what the market size is like, 278 trillion is the value of global real estate. The average transactions in commercial real estate in the US, the transaction volume over the last 18 years has been about 320 billion. Tokenism is looking to capture only 3% of that, which is $10 billion over the next 5 years. We list only commercial real estate assets focused on stable income properties, redevelopment properties, and ground up developments. Our business model is purely a transaction fee based model. While our platform is a zero fee platform for the first year, we expect to start charging fees once we have retail investors on our platform. Customer acquisition costs are relatively higher to start off with, as we're open to accredited investors only. We expect to start by spending $50,000 a month from our formal launch, and at about $500 per customer, which drops down to about $350 per customer once we have our exchange license and are open for retail investors. We ensure the true alignment of incentives for all parties involved: property owners, brokers, investors, property developers, the whole 9 yards. Talking about competition, we've segmented the competition in 5 sectors. Block Emo and Realty are existing platforms doing similar things, but they lack a secondary marketplace. They don't have enough inventory. They're not open to US investors, and so on. Other competitions include platforms like Harbor, Securitize, Polymath. Now, all of these are great platforms for tokenizing a single asset, but they're only a piece of the puzzle. They don't offer the entire solution. They don't offer the complete solution. They're not a place to market or manage or syndicate deals and have a secondary marketplace that they offer. Real estate equity plays such as Compound, which recently got acquired by Republic. Crowdfunding platforms like Cadre, Fundrise, CrowdStreet, they offer lower minimums, so down to about $50,000, but at the same time, there's no liquidity. REITs, on the other hand, we don't consider as much as competition, but we truly think we're a good solution for REITs to diversify their existing investments. Our competitive edge, no doubt, is our global team with deep experience in real estate development, management, the whole 9 yards. We've worked with a local law firm, Taft Law, regional law firm, to work on our compliance aspect of it. We wanted to ensure that our platform is 100% in line with SEC and FINRA when we go live. We worked on our compliance before we even started our technology development. We've secured a significant number of assets, 14 to be exact, that we're listing on the platform even before we went live. We have access to those platforms. We've created our own stablecoin to eliminate any volatility associated with any cryptocurrencies or digital currencies. And we make real estate investing more accessible and efficient by tokenizing these assets. Down to our financials. As I said, we're a zero fee platform for the first year. So you see minimalistic revenues coming up, but starting the end of year one starting the end of 2021, those revenues start jumping up. Once we open up to retail investors, you can see how they go up to 78 million in 2023. One thing I'd like to point out at this stage is by 2023, we're only looking at capturing 1% of that 320 billion average real estate transaction volume in the US, or commercial real estate transaction volume in the US. Going over our team, we've got a great global team. Our CTO, Zian Van Vick, our director for offshore operations, since we are a fairly global team with operations not just in the United States or not just in Cincinnati, but also in Europe and Asia. Our head of technology is Mohammed Musa. Our head of strategy is Justin Jensen. We've got a great group of advisors from Renee Basson, who is heading Team 8, a VC firm. Omer is a senior partner at EY in Toronto. Koji is a local Cincinnatian, an executive at P&G. Bassam is the creative excellence director at Coca-Cola China. So you can see that we've got a wide array of team members. These are only our key team members. So our experience-wise, we're 30 plus years in real estate, 40 plus years in data analytics and technology, 12 plus years in blockchain development. Management is over 80 years and 15 plus years in marketing and sales. So we've tried to put together a great core team, which provides experience all the way across. Obviously, I'd like to mention Taft Law as our counsel and compliance, and Deja Williams is leading our digital and marketing, and she's also based out of Cincinnati. Happy to answer any questions. My contact information is on the screen. Feel free to reach out to me directly. If anyone has any questions, I'm happy to answer those.
Hang on. All right. Well, hang on because we may get to some Q&A, but I want to do the next one. First off, Mohsen, that's fantastic. I'm ready to quit my job and join you. What an impressive momentum group of folks that you have behind you. And let me now move over to Kevin Mackey, who is a co-founder of Coterie. And let me add with pride, as I did with Sarah, that he is another Centrifuge alum. Kevin, you have the floor.
Thanks so much, Pete. This was a fantastic discussion. It's been really cool to be a part of it, not only because of my background at Centrifuge, but being a lifelong Southwest Ohioan, being born and raised here in Cincinnati, and then going to the University of Dayton. I take a lot of pride in us being able to be this region, this fintech or insurtech hub. So I'll actually start with just kind of a story about how we had gotten started and how important Cincinnati has been to us and continues to be for us. And I'll do that before I give the product demos, and then towards the end of my 10 minutes here, I'll actually talk and show you what Coterie is doing. So just a quick tease on that, I should probably give a little context and then talk about the story. We are doing API-based commercial insurance. And so what we're doing is we are digitizing and attaching commercial insurance policies in the apps in the marketplaces that, in particular, small business owners are already using. And so a case in point for that will be Quickbooks. Lots of small business owners use Quickbooks to run their entire financial lives. What we are doing is we are connecting our API to them so that we can immediately underwrite and attach insurance policies in the places that they are already doing their business. So we had gotten our start in 2018, and Cincinnati was the region that we had chosen. Our CEO and founder, David McFarland, had actually moved here from Chicago. And part of that was because he had had a mentor who ended up becoming one of our angel investors, had suggested how nice Cincinnati is. It's great for families. And also has, quite a bit of insurance knowledge. And that is exactly how we got our angel round, is that we were able to raise mostly from former insurance executives that very clearly knew the problem that we were trying to tackle in being able to distribute these small business and other commercial insurance policies, much easier and much more digital than had previously existed. So we raised about $625,000 and was able to hire either full-time employees or contractors here in the city, which led to our $2 million Series Seed Plus round. Now, why I'm being very specific about that, I guess, is because I want to give a big shout out to Western and Southern, and in particular, Ben Fosh, who had made sure that Western and Southern was a part of that round. And so, again, the Cincinnati connection has been with us through and through. We were able to take that money and we hired a lot more people and a lot more talent in Cincinnati. And I know that there was a lot of discussion between Elizabeth and Sarah and Justin and Kyle, all great discussions on talent, and why I want to kind of tell you the story is that we have been able to find the talent that we wanted here in Cincinnati, especially through that Series Seed Plus. But as you're growing and as you're raising, and certainly as a result of COVID, we have grown from a city that is based in Cincinnati to a city or to a company that is absolutely hiring people from all over the country. And one thing that I had written down, and I want to give a shout out to Tim Metzner, who is our co-founder and chief strategy officer, or chief growth and strategy officer. I know he's on the call. I'd actually slacked him and said the words, "We are a national employment brand. We can start and did start here in Cincinnati, but our brand, whether it's as a product or as an employment company, is absolutely national. And that means that as a result of COVID, we've been able to hire tremendous talent on the engineering side, on the insurance product side, both here in the city and nationally at large. But what's really cool is that our headquarters are here in Cincinnati, and we are able to give back to the city and have the city give back to us in pretty tremendous ways. So I see it being a really good, I liked how Justin talked a lot about the collaboration back and forth between Big Co and startup. The way that we look at it is if we build a fantastic culture that is giving people an opportunity to be creative and really flex their intellectual muscles, then hopefully they're going to want to stay with us and work with us for quite some time. But we understand that there are many different seasons of life and different flavors of life. And there are going to be times where people move from Big Co to us and from us back to Big Co. And we think that that is perfectly great for a region, mostly because we think that opportunity is what really drives people to come into the city and then hopefully stay here. So as we create more job opportunities, as we create more financial opportunities, we believe that that is going to give back to us as a company and then hopefully back to the city at large. I could talk about culture all day long, but I know I'm limited in time. So I'm going to get into more of the coterie, but happy to talk to anybody offline about how we're building, why we're building, and ultimately what Cincinnati has meant to us. So as I share my screen here, hopefully you can see it. There we go. You can see that we are simplifying insurance for businesses. This is certainly our mandate. Right now, our flavor is mostly on the small business side. But again, our technology can translate into multiple different markets. For example, the small business products that we are actually writing, I'll kind of skip around on some of these slides and not get too insurancy on this because we're limited in time, but we are selling general liability, professional liability, and business owners products, and soon to be workers' comp, which is what most small businesses need. If you are a small business of one, an individual, maybe you don't need a workers' comp product, but you probably need a general liability product. But we're also servicing companies up to 50 employees, in which you might need every single one of these things. And so our ability to, again, attach and digitize insurance right where people are already doing business and using the data that is already existing in their business, it helps us identify and sell the right types of products to them because of that educational piece, because we understand that each business is different and that each business owner wants to be educated in understanding what they have purchased. And so the digitization of all of this is what allows that allows that to be possible. So I could go on that for a long time, but again, because we're limited in time, I'd like to show a quick demo on what that would mean for a payroll type partner. So again, think payroll. You've got all the information about your employees, you know which types of employees they are, you know how much you have paid them. All of that is very valuable to an insurance company like ours. So where there's a very natural partnership is that we want our small business customers to have access to our products without us having to have a very large cost to acquire those customers. I know that I had heard, it might've been Kyle, talk about how there's kind of this transition from a large CAC and maybe some personal realms into what we hope to be for our business, a much smaller CAC, because we're able to reach our end customers while also providing value to the platforms that we are partnering with. So again, just to summarize that thought, these payroll companies or accounting businesses or whomever else that we're working with, they want to make their platforms sticky. And what our technology allows for that to do is to keep people on the platform, because as you'll see here in a series of clicks, it is very easy for us to be able to, in their platform, help their customers see and understand what they are purchasing, input just a little bit of information that might not already be in their existing system, see a very quick summary, and then ultimately enter credit card information and buy a policy. And boom, then you're done. You've gone on with your day. You understand your insurance, and then you can do the same thing next year. So with all that being said, I'll kind of stop sharing my screen because I'm sure we're probably up against time. But where we are as a business is that we're going to be going into, so we raised our Series A. I think it was about the week before COVID hit. So very, very grateful on timing for us. We are now hiring to get to the point where we will be raising a Series B sometime mid to summer of next year. But of course, going into that, having lots of interest in the Midwest, having a lot of different investors that are coming in through Centrifuge, it certainly helps make our life a lot easier to be able to have that type of podium so that we can share our story. So thanks so much for the time, Pete, and happy to answer any questions that you all have.
I love this energy. This is a proxy for what we're going to build, create, multiply. And thanks so much, Kevin and Mohsin, for a fantastic review. We're not going to have time for a lot of questions. So what I would suggest to everybody is that reach out to us and we will facilitate a connection with both of these outstanding entrepreneurs. Again, our goal with Fintech Frontier, we're just starting the conversation. This is going to be a bit of a movement. I just actually saw an article in the Biz Courier about what we're doing. So we're building some real momentum. So thank you. A few kind of closing comments. First off, thanks for a fantastic conversation and showcase. Week after week, I keep coming out more energized about, after these sessions. As we wrap up and look towards the exciting pitch competition that's coming up on October 29th, I repeat, write that on your forehead, October 29th, I want to share a couple reflections on this series. Let me start with a few high fives. I want to thank once again our founding partners, Fifth Third and Western and Southern, who made this Fintech Frontier series possible, and even more so are going to lead the way in building Fintech Frontier into a game-changing platform for startup innovation here in Cincinnati and the Midwest. And we're actually hoping to get all the banks and insurance companies to contribute to this platform. So if you're listening, that's a hint. Early lead. Second, I want to thank our incredible panelists and moderators who hailed from Brewer Lane, Revolution, Portage, Fika Sandbox, AmFan Ventures on the investor side, Western and Southern, Fifth Third, Generator and EY on the corporate side, and Solo Funds, MocoFi, and Policy Genius on the startup view. These have been insightful and invigorating conversation that are surely going to ignite innovation to come. So a big muchas gracias. And third, I want to thank and celebrate our showcase startup stars, Pay Theory, Tokenism, and Coterie. We're behind you. We want you to succeed, and we couldn't be prouder of what you've accomplished. Thanks for your leadership. This has been a home run series of events. More than 400 participants have joined for our discussions, and they really have brought fantastic vertical expertise. Attendees have come from 20 different states and 9 different countries. We've heard from 20 different leaders in the fintech space, and we're gearing up for one of the largest pitch competitions of the year in a couple of weeks. So I could not be happier with this terrific start. I want to quickly revisit why we're launching Fintech Frontier with our partners. Our vision is to create a launching pad for fintech entrepreneurs. We want to attract people who see bold, new ways, where we can make financial services accessible and engaging to consumers, from all walks of life. We want to inspire entrepreneurs who see how technologies from AI to blockchain to IoT can make financial services more personal, private, accessible, and efficient for consumers, for business customers, and for financial services firms themselves. And we want to open up doors for founders from all over the place, including the coast, whose great ideas need enterprise customers who can help them succeed and scale. I'm incredibly excited, and I know that we're unleashing, and I want to thank all of you for your energy and engagement. We'll announce panelists for our pitch competition. Sorry about that. The trials of a phone. We'll announce panelists for our pitch competition next week, and they will compete for $60,000 in prizes. Thank you, everyone. Thank you, Sarah, for moderating a fantastic panel. Thank you for the panelists, and also for our startup showcase folks. Have a great day.